Oh, yeah, this is Art Halleran from Trillion Energy, and I'm here to give a really nice chat.
Good to see you again. I think we saw you back in April. A few things happening. Things are moving quickly. Just want to talk to you first before we kind of get into drilling, etc. Was about the recent farm-in announcement. Not quite sure how the market's taken it. I think some people are looking at that as a sort of change of strategy. Others may be looking at that as a sort of add-on. So who's right? How are you viewing it? Why did you do it?
Yeah, so from the very beginning, I've always said that SASB was going to be the cash engine, and in this time, it also turns out to be the technical engine because people are noticing us because of our success. And we were going to do the SASB, and we're always going to do an exploration block that was going to add a lot more value. So it had to be big; it couldn't be small. And this huge oil type property is a continuation of the one in northern Iraq and Syria. And there are some billion barrel fields, 600 million barrel fields. So that some of the conversations that you're mentioning is people are saying, oh, here we go. The clock is reset. We're now a long lead item again, long term, and they're not going to continue with SCSB. Well, we are continuing with SCSB. We are now a gas producing company. We have the field developed, and we're going to continue to develop after we maximize our gas production at the time. So we've actually have done what we said we're going to be doing.
But let's be clear, because I think it's easy for people to kind of get confused or get worried about things, all right? So because it's because of the part of the world that you're in. First of all, there's an offshore project. Offshore tends to be expensive. I think we've talked in the past about 11, 13 million sort of dollar type holes that you're putting in. So economically, does SASB stack up? Let's clear that up.
Yeah, so SASB with the wells, like the $13 million wells and the gas that we find and the price we're getting at $11.65 does stack up and it's economic. And so all we're really doing now is we have the 5 wells, and it initially was going to be 5 wells and 2 recompletions. And what we've really done is done 5 wells, 1 recompletion, and instead of the second recompletion, we slipped in those 6 sidetracks, and all we have done is move those 6 sidetracks to mid-2024 because we are doing our 3D seismic reprocessing. That'll be finished in September, and we're mapping it. And already we can see some fairly good size stratigraphic exploration gas projects on SCSB. So it's much better to sit there and you have your stratigraphic exploration targets, your follow-up targets from Program A, and your sidetracks. And capital is always finite. And so pick the best selection of those, and that would be our next drilling program. In the meantime, all the wells that we have drilled, we've actually hit more gas pay than the offset, and some of them at a fairly high pressure. So when we maximize the gas production, we'll probably end up doing better than we anticipated. And we will have good production from now until we restart our program. And we have a rofer on the rig. Now, when you talk about the onshore versus the offshore, we have 1 rig. So it's very competitive. Like you say, it's $12 million, $13 million a well. Onshore, there's lots of land rigs. The wells cost actually $2.5 million, and then there's a $500,000, like road costs and so on. Offshore, our goal was about 1 million BOEs for the $13 million bucks. Onshore, we could find a 5 million, 50 million, or 500 million barrel field for $3 million, right? It's
right.
way cheaper.
I get that, Art. And it is way cheaper, but that's the point. And I kind of want to let me just stick with the offshore bit, because I want to make sure people understand the rationale here. Right? You're saying that, and I don't mind this. It's an add-on rather than an instead of. I think that's what we're hearing, or people should be hearing loud and clear. But And we have to say to our investors or subscribers here, if the data changes, you can change your mind, right? That's the sensible thing to do here. But would you, if you'd not picked up the onshore assets, would you still be moving your plans to 2024, or would you actually be carrying on because the market expects you to kind of carry on with something?
Yeah, that I never anticipated, because we were always going to pick up an exploration block. But if we did not have anything else, I still would be in the same position I am right now. I would still do the same, because when you drill for a year, you find things out. So an example would be, we drilled 5 wells, and so we know all the things about it, the costs and so on. The wells cost $13 million. It is bad business not to take a look at everything and say, okay, can we do it cheaper and can we do it faster, right? At the same time, we might end up saying, if we continued, we would drill the side tracks and we spend that capital. And then we look at the fact that some of the stratigraphic targets are larger, and instead of 2 wells, we could do it 1 well because it's not faulted. And also the other thing I tried to get across to the investors is that with our facility right now, because we end up having better gas at higher pressure, we're not having problems, we're having challenges. So an example, and this is a specific example right now with Alapili, the well we just put on now, we have to produce that severely choked back. So we're at a 2064 choke, and normally they produce at a 32-64-inch choke. The reason why we have to choke it back, and it's still producing 9 million cubic feet per day at that choke, is because of the pipeline pressure. When the gas goes into the pipeline, it builds up the pressure, and it was going to back out our other well, the Hanley, which is also a good producer, right? And we're producing 14 million cubic feet right now with 3 wells. And so what's happened is when we end up backing out one of the other wells, and it's like sending a pressure wave through it, the wells have to also produce through the water, and it gets a water block, right? And so we're going to be using an ESP on West Akachoka and solve that problem. But if we continue to drill wells, we're going to find gas, we're going to invest $13 or $11 million, and then that well is going to sit there and maybe not produce at its maximum production. And so we're not paying back the capital as fast as we could, right?
Right. Okay. So what I'm hearing is you're taking the new data and you're trying, because these fields need to be managed, right? It's a balancing act, isn't it? Where you can't go full bore off on one side of the field and expect it not to affect anything else, nearby. Of course it won't. So I understand that. But maybe just in terms of simplifying it for some of the audience, perhaps not quite as au fait with matters. Can you talk about that component in terms of the getting that balance right, and some of the variables that you've got, or some of the tools you've got available to you to do that?
You mean for like in the production in the field?
Well, yeah, because you're talking about being we're taking this as an opportunity to maximize efficiencies effectively, right?
Yeah, okay.
So you've got some tools, you've got some data available to you, but you're also going to have some tools available to you that you're going to want to work at the best balance for when you get into 2024 versus how you've been doing it, to date. So what does that look like?
Yeah, I understand. So I can say that we can do a short-term fix and investors will be happy and they'll see everything fine. But my goal is not short-term fixes. My goal is to get the reserves that we've found. And how you do a short-term fix, you perforate another zone, you increase the pressure of a well that's been blocked off, and it comes back on. The long-term fix is, what's happened is that this is not an unknown problem. It's because we've done the directional drilling. We have an S-curve that goes down along almost like a horizontal section, and then it dips down into the gas. And when the well stops producing, as these wells produce a little bit of water, the borehole fills up with water. And so now if you have back pressure in that weighted water at the perforations, it doesn't produce. This is a common thing in horizontal gas wells. All you need to do is pump some of the water off. So you lower the weight at the perforation intervals, and we're using a slim hole ESP, which is quite amazing because we can slip it down our 4.5-inch tubing. They use that in other other places and the shale gas in the United States. And so we're going to be testing that in West Akachoka because regardless, we'll end up using that in all our wells in the future anyways, because right now the wells are stopping at 2 million cubic feet per day, which is quite high because of the long interval of the water. But if we pump the water off, we can probably pump the gas down to like 200 MCF per day. The other thing that's really advantageous of it is that right now we perforate a zone, and then when the pressure goes down, we perforate another zone. If we manage the water and pump the water off with the ESP, we can perforate all the zones because we don't worry if there's water coming in because we can pump it off. So this is how we can solve it. The short-term fix, and we're doing it in South Akachoka, is we're going to go in and perf more zones. So we'll go from the 2 million cubic feet per day that it was stopped at and go back up to 4. And that will give us instant revenue. But at the same time, we have to solve it for long term, and we're doing that with the slim hole ESP.
Right. Okay. Understood. And I guess the other component to this is money, right? So when we first talked about a year ago, when you first started drilling about a year ago, it was into a very high gas and price environment. It's obviously come off a bit into say more reasonable and normal type numbers. But you took advantage of that. That kind of allowed you to fund things, fund programs, fund drilling. Right now, in terms, you said it's an economic. The offshore is economic, but with this sort of stretching out, elongating of the plan, how are you for money today? What does that do to your kind of cash needs? And obviously we've got to talk about the onshore farming. It's going to need financing. What does that look like?
Yeah. Okay. So again, for this one, there's actually two issues, and the two issues are money and how the money is managed. So because we did the long reach directional drilling, we had to bite the bullet in a lot of stuff because nobody believed we could drill it. And so we had to, with our partner, we could not, a normal JOV, you say, I want to drill this well, and you get paid up front. And the first program A was we had to show we could drill the well. And once we set the packer, they knew the well was safe. We did a cash call, and TPO paid their percentage, right? The next set of wells, it's up front. So the reason why I'm saying that is so we were stretched because we had to carry the full price of the $13 million. Then we did a cash call and we got half that back. And the next program, that's not going to happen. We're going to get the money up front. So we don't have that have to manage the money as much. The second aspect of it is the burn rate is about $6 million a month when we drill. Well, if we don't drill, we don't have that burn rate. But we're still making the same amount of revenue. So if we weren't making the $6 million before, say we're making $4 million a month, and right now with the $14 million, we're at $11.65. We were making about $2.3 million US. That's our percentage. And once we get the short-term and the long-term fix, we should be able to double that. So now you're making $4 million at least a month, and you're not having a $6 million burn rate. Your burn rate's about $1 million. So now you're pocketing about $3 million. When you look, so that means in the future, right, we have some money saved and so on. But at the same time, when you look at the oil prospect versus the offshore, the magnitude of required capital is quite different. So it's a good farming. For the first 2023, we have to spend about $3 to $4 million US on seismic. I just said we're going to be making 2.3 at least with 3 wells US a month revenue. For 2024, we have to drill 4 wells. They're 2.5 plus a half, so that's $12 million for 2024. We have to pay that 100%. We have now earned into the block. The exploration part of the block continues for 2 more years, and each year we have to drill 3 wells, but at only 50% cost because the other partner comes in. So if you look at the cost for the exploration block, it's manageable. That's not an issue. But like you say, if we start looking back at reinitiating SASB, we have to have some cash in our pocket. And like I was saying, that's why I want to sit back and say, okay, what is the best impact for the dollar on SASB? But if we happen to hit in the oil prospect, that's a different ballgame. That's
absolutely. But again, let me just. I want to finish on SASB. So it will generate you that amount of cash per month, which is great, and without the drilling between now and so when you talk about 2024 program, what are we talking about? Q1, 2, 3, or 4? How long will you be drilling at these kind of lower OPEX costs with the cash coming in? How much can you save up, I guess?
Yeah, so our right now the sidetracks, we still have the sidetracks. They're all ready to go, and we actually have bought most of the long lead items. So those will be, if nothing else comes out, we would end up doing start initiating drilling that. So you're talking about May, June. For the large exploration ones, if they're close to a tripod or a platform, that's less capital. If they happen to be, and that's why we have to take a look at it, you find a large stratigraphic one, and maybe it's close to some of the other structural ones that you can't reach, you now have to say, okay, we have to do another platform or a tripod. And now that's starting to run into capital, right? So you got to sit back and see where you are and say, okay, can we do that or not? Like I would like to be in a position for the next phase, depending on our facility and so on, like when we fix that, another 4 or 5 wells, 6 wells, 7 wells, right?
Okay. And I guess if there's new data, you'll change your mind. That is a sensible thing to do. We agreed that earlier. And okay, I guess what people are going to be concerned about is like committing to stuff now for the land-based projects with this JV. It doesn't sound like you're kind of rushing into huge amounts of capex for that or opex ongoing. So can you give me the sort of structure of the deal and over what period and what do you earn into and what do you actually end up with?
Yep. So the expiration phase of this permit, one is 2027 and one is 2028. And there is a total of 10 wells that have to be drilled to earn into the block. You can, if you find a discovery, you can declare a discovery on that and get a development permit or a production permit. But for the block, it's 10 wells and 340 kilometers of seismic. For us to earn 50%, we have to, in 2023 and 2024, do the 400 kilometers of 2D seismic. It doesn't mean we're going to do 2D. We might end up doing 3D put more money into it, because we're not just going to do something to qualify for the permit. We're going to actually make sure it gives us something good. But that's the minimal. So it's 341 kilometers of 2D seismic, and we drilled the 4 wells in 2024. We now have earned 50%. We will always be the operator, and so anything to earn continuing in the future to make it from an exploration block to a development block, we have another 6 wells, which we pay 50-50. If we have a discovery, so we drilled a well and we have a discovery, we test it. If we want to put that on production and perforate, it's now 50-50. So we're only paying 100% for the first 4 wells and seismic to earn into the block. But if we drill one of the first 4 wells, say we have a discovery, any completion and so on is 50-50. Any development is 50-50. It's a good deal.
It's a good. Okay, you say it's a good deal, and I've heard you say elsewhere it's one of the best exploration projects that you've seen in your time in the game, and you've been around the block, right? But given the early stage nature of this, is that one of those it's relative type statements, or is this based on something? Why do you give it such large plaudits or such good plaudits?
Yeah, the reason is if there was nothing found there, if there was nothing in Turkey around this block, it'd still be a good exploration block because the band carries from northern Iraq with the huge fields through Syria and then just goes right into Turkey. But when you start looking at the discoveries we have on the Turkey side, so these two blocks, the three blocks actually, it's about 22,250 square kilometers. They were given out a couple of years ago, and since then, in December 2022, TPAO, the Turkish Petroleum Company, about 11 kilometers from the eastern border of one of the eastern block that we farmed into, found a huge discovery of about 650 million barrels. And then in May this year, they found 1 billion barrel fields. And those might be political numbers, but 1 billion barrels maybe is 400 million. This is very light oil. And so you have these two huge discoveries, which are anticlines, by the way, because they just follow the anticline trend because it's like the foothills, the overthrust type thing. But then if you go to the northern part of this one block, we have other fields that are like 50 million barrels, 5 million barrels. And then right through our block on the northeastern half, there's no seismic, no wells, nothing, right? On the southwestern part, there are some wells that are fairly old, and the recent one, which they never managed to test, and that's the people that farmed out. So that's the eastern block. On the western two blocks, you have the old fields, Raman, found in the 60s, and also the 80s. And these are like mini research papers and so on. We're talking 650 million barrels, 1.8 billion barrels, and they're mere kilometers from our border. The ones to the recent discoveries are 11, 12 kilometers. Also around these blocks are many 300, 250 million barrel fields. So it's not, like a pie in the sky, and it's really trendology. There is trendology, but it's also circled by many proven fields. And then when we look at the work that's been done on these blocks, they drilled, it's old seismic, some of it, and it's not mapped properly. So when they drilled, they thought they drilled a structure. They had horrendous amounts of staining. And we look at it, most of the tests, they just recovered filtrate. They never really actually recovered the formation fluid. But when we have our guys remap it, it turns out a lot of the structures they had are just reflections. They aren't really structures. So why is this good? Because we're going to find probably a lot of 5 million and maybe 50 or 20 million barrel fields. But on the most eastern block, there's nothing to say yay or nay. It's anticlinal structures go right through the northeastern part of it, and there's no seismic or anything that prevents you from saying that there could be something there. And that's the reason why it's the best block I've seen.
Right. Okay. So, and this is in the wonderfully named Batman province as well. I should say, well, right. Okay. I think people should perhaps take a look at some of the producers in the region. It's pretty extensive. Look, I guess we better just let you get on with it, right? That's the proof is in the pudding, and we want to see how you come at this. So I get it. So it's not a change of strategy. It's not a segue. We're not, the goal is the same. You've picked up something else as well. You are going to optimize the offshore and get after the onshore as well. Okay, understood. Commissioner Gordon understands. So that was a Batman joke, quite a bad one. Okay, well, look, thanks for coming on the show. Stay in touch and let us know how you get on, and we will speak to you soon.